Hi everyone, welcome to the final session of the course Corporate and Business Law. So, over the past weeks, we have built a very strong foundation in business law. We started with contracts, moved to sale of goods, explored partnerships, and we also understood about the company structure. And today we are closing this journey with something that connects to the real world money transactions, that is Negotiable Instruments Act. So, before I begin, let me just revise the previous session. Okay? So, we have understood that in businesses today, we always don't pay in cash. We also use checks, written promises, and credit instruments. And that is exactly why negotiable instruments play a very important role because they act as a bridge between trust and money. Okay? And like we had understood in our previous video, a negotiable instrument is simply a written document that represents money and can be transferred from one person to another. And we also understood the three main types of negotiable instruments. Can you recall them? Yes, it is promissory note, it is bill of exchange, and check. Okay, now let's go one level deeper because understanding theory is one thing, but actually applying it in real life is what truly matters. Okay, so let me ask you something. If at all someone gives you a check, are you automatically safe? Not always, right? That is why the law introduces two important concepts, that is, holder and holder in due course. So, what is this holder or who is this holder? A holder is simply a person who is entitled to receive the money. Okay, whereas holder in due course. Now, this is a little more powerful. A holder in due course is a person who receives the instrument for consideration. He receives it in good faith and receives it before it becomes overdue. Now, why is this important? Because such a person gets better rights even if there were problems in the previous transactions. Okay, let me explain this with a simple example. Suppose a check was originally obtained through fraud. Okay, but later it reaches a very genuine person who accepts it honestly. Now, this person is protected as a holder in due course, and this actually ensures confidence in business transactions. Okay, now let's talk about something which is very, very important and something which I'm sure you all might have heard about. Have you heard of check bounce cases? Now, what do you mean by check bounce? So, check bounce is actually called as dishonor of check. Why do you think a check will be dishonored? The check can be dishonored either when there is insufficient balance in the bank account or maybe when the signature does not match. Okay, or also because if at all the account is closed, again the check can be dishonored. Now, once the check is dishonored or what we call as check bounce, what do you think will be the legal consequences in such cases? Now, in such cases, the law makes it very clear. The law says the payee must send a legal notice to the drawer within 30 days. Okay, and the drawer must pay within 15 days. If not, a legal case can always be filed. And this, after filing a case, may even lead to a fine and imprisonment. Okay? So, what is something that you all should remember is don't accept checks without verifying the credibility. Okay, because this can lead to cash flow issues and to legal complications, especially for the entrepreneurs. Okay, now think about this. Have you seen two parallel lines on a check anytime? What are these parallel lines for, or what is it called? It is actually called as crossing. But why do we have to do this crossing on the check? Because this crossing on a check will increase the security. Okay. Now there are different types of crossing. I'm sure you all might have seen it sometime. Okay. So let's understand these different types of crossing. There is a type of crossing called as account payee crossing. Now, if there is account pay crossing on the check, it only means that money will go only to that person's account. That is what it means. Okay. And if at all you see not negotiable crossing, okay, then it means that it limits the transferability of the check. Okay. So, crossing ensures that money does not go in the wrong hands. Now, this is widely used in business payments. Okay. Now, um, let me speak to you as future professionals or even maybe as entrepreneurs. Okay. Negotiable instruments are not just legal concepts. So please keep this in mind because these are tools of financial discipline because they help in managing the credit transactions, maintaining the payment records, building trust in business relations. Okay, but like we already know, it also carries the risk like check bounce, risk of fraudulent endorsements, or even risk of delayed payments. Okay, so what you should remember here is verify the party before accepting any negotiable instrument and make sure you maintain proper documentation and also you have a clear understanding of the legal remedies as well as the legal consequences. Okay, now we have come to the end of this course and I want you to reflect on one thing. Business law is not just about the sections and rules, but it is mainly about making informed, ethical, and legally sound decisions. So, from signing a contract to selling goods, to running a partnership, to managing company structures, and finally to handling financial transactions through negotiable instruments, you are now equipped with the basic or foundational understanding of business law. I hope this course has not just helped you academically but also practically because whether you become an entrepreneur or a finance professional or a manager or just a responsible citizen, these concepts will stay with you for life. Okay? Thank you for being a part of this learning journey, and I wish all the very best to all of you in your future endeavors. Thank you. Have a good day.